Good evening, everyone. I'm Seb Leo. So if you need to, if you've got questions, either questions that I didn't answer, or you've got questions after the lecture, those things happened, don't hesitate to send me an email. We're going to see each other a few times. So today and tomorrow, it's portfolio. So today, we're going to do the easy bit, just set the definition and the big ideas. And then tomorrow, we get into the optimization. Then I'll see you again late August, August 21st, 22nd, and we will go through Black-Scholes using martingales. You've already seen martingales with Riaz, right? Oh, well, you'll see them again. You'll have fun with that, really, seriously. If you don't have fun when it starts, you'll have fun when it ends, you know. So we'll see each other for Black-Scholes with martingales and more fun with martingales the next day, but the next day will be a bit softer. And then it's September, we'll do a bit of data science, a bit of filtering as well. And finally in October, you remember I told you about martingale, right? You've already seen that with Riaz, right? We'll see it again, but for fixed income. So that's what we will do together. 2 weeks ago, Bill Zimba came here and gave a lecture, a guest lecture. Who was attending the lecture? Did you come? On July 15th at 6 o'clock in this very room. I was watching online. I recognized the control there, so he was here. Did you come? Because he was talking about portfolio. And he was saying some very interesting things. So, online delegates, anyone was attending? Well, anyway, that's something, you know, ditch the movies. There are no interesting movies this summer. So on Saturday night, instead of going to watch a movie or to go to the pub, well, you can still go to the pub. But after that, watch Bill's lecture. It's on the portal, so you can access it. And we are basically going to provide a bit of background for a lot of things that Bill addressed on July 15th. I like the title, because basically the title is wrong, in the sense that we still keep referring to what we're going to talk about today as modern portfolio theory. The problem with that is that there was no ancient portfolio theory to start with, and what's referred to as modern portfolio theory, and that's also the title of many textbooks, etc., is actually now 67-year-old, but still youthful. So portfolio theory and all the tools we use for portfolios have evolved quite considerably since Markowitz in 1952 published the first paper on the topic. Actually, it was not the first. Definetti had wrote a paper in 1940 about portfolio in Italian. And of course, people in Chicago were not really aware of what Definetti had done. But Markowitz started a new field in 1952. The interesting thing is that, as so happened, the field that he started with portfolio had a huge impact, because that was also the start of risk management. That was the start of derivatives. It turns out that Fisher Black was a big fan of Markowitz and of the CAPM and of portfolio. We'll actually bump into Fisher Black tomorrow night when we look at the Black-Litterman model in optimization. And he imported a lot of these ideas in derivative pricing. So we'll talk about that in August. But keep your eyes and ears open, because at times I'm going to tell you, this is what you do when you're optimizing a portfolio. The concepts are the same, but interpreted a little bit differently when we are dealing with derivative. And of course, even what we're going to see today is, I would say, the foundation for a lot of more advanced models, such as the stochastic programming models that Bill Zimba discussed in July 15th. The interesting thing is that it's still very much used at least as a foundation, at least as glue language when you talk between portfolio managers. And it's also very much used even in data science and machine learning as the start when you look at factor models, when you try to estimate factors and build portfolios that are going to maximize returns or minimize risk, as we're going to see, given some data, and you try to estimate some of the factors that will get you these optimal portfolios. So this is old. On many accounts, we can do much, 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 much better than that. But it's still the first step before we start considering models that are more sophisticated and that are more realistic. Oh. Yes, so first online question. Hi, Michael. So it was Bill Ziemba from UBC in Canada. And he gave a talk on July 15th about stochastic programming models. So you can find that on the portal. It's the latest extra lecture. So tonight we're going to cover really the big ideas. Tomorrow we get into the optimization side. So today we're going to talk about risky and risk-free assets. We're going to talk about the meaning of mean variance analysis and optimal portfolio. We'll talk a lot about diversification because that's really the key idea. Hedging actually is a case of extreme diversification. It's a case where, as we're going to see, the correlation goes to -1. So that means you can eliminate risk when you hedge. But hedging is often costly. So one of the first steps that you can go through is actually diversify your risk before hedging really the risk that you really want to get rid of. We'll talk about some more terminology: opportunity set, efficient frontier, tangency portfolio, the Sharpe ratio, and we'll talk about some of the drawbacks of modern portfolio theory and how to address them. So when Markowitz arrived in 1952, he was a young man looking for an idea for his PhD thesis in economics. Economics was just growing. That was the field that was growing in those days, mostly because a lot of students who were studying economics in the 1950s had actually grown up during the Great Recession. So that had kind of prompted them to look at the economic system and try to find ways to understand it and make sure that what they had lived through in their childhood wouldn't happen again. So a lot of advances were made by children of the Great Depression. So when Markowitz arrived on the scene, of course, he was not the first to look at investment. Graham and Dodd, that's the 1930s, that's 1934. John Burr Williams, that's 1938. So basically, John Burr Williams wrote about a framework that is the ancestor of discounted cash flows, while Graham and Dodd wrote about something that is the ancestor to comparable analysis. So using ratios in order to measure by comparing companies with a peer group to estimate to value companies based on these relative measures. So don't put all your eggs in the same basket was already something that portfolio managers were intuitively doing, or most of them, the good ones, were intuitively doing. But for Markowitz, Markowitz wanted to understand what that meant and how to quantify the effect of not putting all your eggs in the same basket. Because a lot of portfolio managers already have this idea that you can't just pile up all of your cash in one security. You need to diversify. But diversification was not really a concept that was studied or something that people agreed on. And in parallel, a lot of other portfolio managers were practicing what's called a bottom-up approach, where they were picking stocks because they like each of the stock individually, collecting them together, and that was their portfolio. And what Markowitz wanted to understand is how stocks interact with each other and how you can best combine stocks together. So I told you that in those days, advances in economics came from people who had grown up during the Great Depression. But it also came from people who had worked in operations research during World War II. So people who were pluri or transdisciplinary, who had a pluri or transdisciplinary approach, who could combine math, economics, optimization, engineering skills in order to solve problems. That's what operations research was. And actually, Markowitz's inspiration for his framework came straight from optimization, from actually operations research. He rewrote this financial question of how I'm going to allocate my money to different securities as an optimization problem. And all the approaches that we've got since then, including Beal's stochastic programming, including stochastic control, which is the stochastic programming's cousin in continuous time. Stochastic programming is in discrete time, and stochastic control is in continuous time. So it's great for quick prototyping to understand how a model works, but of course it's not realistic for for industrial application. So Markowitz imported this framework from optimization and rewrote portfolio in terms of an optimization problem. So what Markowitz managed to show in 1952 is that risk and return are equally important. So you can't have one without the other. Well, yeah, you can have risk without return. But you can't have return without risk. And if you want to produce more returns, it's necessary to take more risk. And that's the idea of risk-return trade-off. When I say more risk, I say necessary to take more risk. I don't say sufficient. You can pile up a lot of dumb risk and end up bankrupt. With somebody else's money, of course. If you want to get more return, you need to take more risk, but it has to be smart risk. And when we talk about smart risk, that's when the idea of diversification comes in. If you want to increase your risk, your return, without increasing your risk too much, or keep a level of return and reduce your risk, you need to do it through diversification across enough securities. And in Markowitz's framework, diversification depends on one statistical parameter, which is the correlation of returns between the various securities. So it's the correlation which you find in the variance of the portfolio, because the variance of the portfolio uses the covariance of your securities. And that's this correlation that gives you or dictates how much diversification benefits you get from your portfolio. So those are the ideas that we are going to explore tonight. Of course, that was a start, not an end. In the 1950s, actually, we had all the ingredients that would lead to finance and quant finance, because in parallel, Arrow and Debreu came up with the idea of state securities, which is used in derivative pricing. And Modigliani and Miller, in the mid to late 1950s, came up with their indifference results, their various propositions, and that's actually the birth of corporate finance, looking at dividends and looking at capital structure. So after Markowitz, Sharpe came up with a variety of linear models. So one which is the ad hoc model, which is what we are using when we use a single factor model, and an equilibrium version, which is called the CAPM. There were also many other contributors, such as Jack Traynor, John Lintner, and Jan Mossin, who came up and also contributed to the story, to the development of portfolio theory. By the late 60s, everything was pretty much set. And although the framework is used nowadays, a lot of the extension after the 60s came in terms of stochastic control, stochastic programming, as well as parameter estimation, which is something we'll discuss a bit later. So as I mentioned at the very beginning, this is actually quite important because without that, we wouldn't have quantitative finance as we know it. We wouldn't have risk management as we know it. Risk management, quantitative finance, derivative pricing borrow a lot of the terminology and key ideas from portfolio. Thanks, Victoria. She just sent the link to asset and liability models that are useful in practice, to Bill's lecture. So that's Harry Markowitz and William Sharpe. So let's talk about Markowitz's setting. The first thing that you notice when you read the paper that Markowitz wrote in 52 is that he lays out very clearly what he's going to discuss and what he won't discuss. So Markowitz starts his paper by saying portfolio essentially has two stages. The first is a formulation of belief about the performance of securities. And the second is, once you've got this belief, how to optimize your portfolio. And my paper is only going to talk about the second aspect. So notice two things. First, we're not going to talk about parameter estimation tonight. Because for Markowitz and for a lot of research and a lot of methods that were developed since Markowitz, the focus has been on the optimization aspect. We assume we've got the parameters, and this assumption is in practice costing us dearly, but we assume we have the parameters, and now the question is, how do we optimize? So up until late tomorrow night, we're not going to really talk about parameter estimation. The second thing to notice from Markowitz's statement is that he's not telling you how you're going. He's keeping his question quite general, meaning that he talks about beliefs about the future performance of securities. He's not telling you, I assume that you've got a good econometric model or you know how to do some statistics. You're going to estimate your parameters this way and that way. Maybe through a regression or maybe simply using a statistical analysis of historical data. He doesn't do that. He talks about beliefs. And actually, he leaves it quite open. He actually, in 1959, started to look also at subjective probabilities, how to incorporate opinions to formulate your expectation about capital market, about the future behavior of capital market. And that's something that we'll explore through the Black-Litterman model tomorrow night. There is a whole range of things that you can do in order to get the parameters for your portfolio optimization problem. And using only historical data is probably one of the most dangerous. But it's in every book because it's the starting point. However, there is nothing wrong with talking to experts, as long as you know how to handle them correctly. There's nothing wrong about using alternate scenarios, including stress test scenarios, to fatten a little bit the tail of the distribution. There is nothing wrong with working on several assumptions, such as several correlation matrices, which is something we'll discuss tomorrow night. Keep your mind open when you look at parameter estimation. It's a big, big, big topic and very important. So, Markowitz setting from 1952. We are in an economy with n assets, 2 at least. Otherwise, there's not much portfolio optimization you can do if all you can buy is one asset, right? So you've got at least 2 assets. You start with a wealth, W pound. So congratulations, Fitch Learning has just given each of you £1 million. Yeah, Randy will come and make an announcement a bit later. But there is a catch. You get your £1 million here. And you've got a number of securities that you can invest in worldwide. So the idea in Markowitz's framework is that today you're going to construct a portfolio by investing in these securities, in these end securities. You're going to construct your portfolio now. And you will not revisit your decision. So I'm going to give you a 20-year time horizon. So for the next 20 years, you're not going to touch your portfolio. It's a one-shot only, one-period model. So I don't know what you're going to do over the next 20 years. Maybe you're going to walk, or maybe you decide to retire tomorrow and drink margaritas on a beach in Mexico for the next 20 years. It has to be a very big margarita if you drink the same for 20 years. Or you drink very slowly, I don't know. And then in 20 years' time, we're going to look at your portfolio and how much money you've made. So to achieve this objective, when you constitute your portfolio, you can buy any securities, you can short securities, you can invest, even put money in a bank account. Now that's a buy and hold model, and already you can see that it's not realistic because we would like to be able to change our decision at some point in the future, especially if something happens. You know, you want to be able to revisit your portfolio, I don't know, for example, on October 31st or November 1st. Just saying, just a date off the top of my head, just saying. That's what, for example, things such as Beal's stochastic programming bring to the party. It's the ability to change your decision and to alter your portfolio at some point in the future, which is not in the basic model here. Now, what else do we need? Well, we need to know what we're talking about when we talk about assets. Now, that's a very slippery notion because assets mean totally different things to totally different people. So if we want to take the widest possible definition, that's the definition that people in economics would have, an asset is anything that's traded or tradable. So you've got all the financial assets, equity shares, bond, currencies, all the real assets, commodities, real estate, collectibles, you know, all your artwork, your fine wine, the one that you're not drinking, that you're just collecting, manufacturing plant, if you're into that sort of things, consumer good, but also intangible assets such as labor income. So that's a very, very, very big definition. If you compare that to the definition that we've got on market, if you talk to an equity portfolio manager and you say assets, they are immediately going to translate that into, oh, I'm a UK-based equity manager, asset equal shares. UK shares. That's actually a very small subset. So whenever you look at a method, whenever you look at a paper, whenever you look at a problem, you need to be clear on what you're going to define as an asset. This one, for example, for most applications, we don't care. It's too hard to measure. It really sounds like central bank economics. Except that if you want to work on an application on retirement, labor income is actually something that you need to consider. Because the way you're going to save money, the way you're going to invest your money, is actually heavily related to where you draw your money from. You don't want your portfolio to be too correlated with your source of income. A couple of years ago in the US and Canada, when oil prices plunged and a lot of small oil companies were on the verge of collapsing, many employees regretted their choices of pension fund because they had invested massively in their company's stock. So they got hit twice. Once on their financial, and the second time on their job. Some of them lost their job and they lost their savings. So labor income, for example, is something that is crucial if you want to work on long-term investment and on pension problems. So your definition of assets need to be sorted right from the start. It depends on the problem you're working on. It depends on what you've got access to. The second idea that we are going to explore is that of how we constitute this portfolio. And the way we are going to look at the portfolio is actually looking at what we call portfolio weight. A portfolio weight is just the proportion of our money invested in an asset. So if I say I'm investing 10% of my asset in stock XYZ, 10% is my portfolio weight. I'm not talking about the money that I've invested. I'm talking about the proportion of my money in that stock. I'm not saying I've invested 10,000 in bond ABC. And the reason why we do that, there are actually two reasons to do that, is that as the value, the total value of your portfolio changes, because the market goes up, market goes down, you get dividend, you get coupon, you reinvest, etc. This idea of proportion is something that's not affected by where your portfolio is at right now. If I say you should invest 10% because of your risk aversion, you should invest 10% in XYZ, whether you've got £1,000 today or £1,000,000 today, it's still 10%. So this way we split between how much money you have and where you need to invest. We've got a relative statement that is not affected by the actual wealth that you have. The only relevant variable or parameter from that perspective is your risk aversion. And that's what's going to dictate where you're going to put your money, not how much money you've got at any point in time. So everything we're going to do is in terms of those proportion, these portfolio weights. And that's actually something that's a bit different from what you're going to do when you build a hedging portfolio for a derivative. So when you allocate your money to your savings account, you deal with weight. When you're trying to build a hedging strategy for a derivative, you're going to talk about units. So just something to keep in mind. It's still a portfolio, but we have used a different type of concept to construct it. The idea with a hedging strategy is that if I want to sell you an option and I need to build a hedging strategy for that option, I need to build a hedging strategy per option for one option contract. So that's why we bring everything back to one share, one unit, one contract. But here, we don't have this constraint. All we know is how much money you've got in your pocket, and all we want to know is how you're going to spread this money around to maximize your welfare. So we are going to deal with weights. Let's now dig into the core assumptions of MTT. So the first and main assumption is that all risky assets are fully characterized by three things. We look at their return and we say, okay, we're going to treat them as statistical creatures, random variables. So we're going to look at the return of these risky assets, and we look at the first two moments of the distribution of return, and that's how we're going to characterize our belief in the future performance of available securities. We look at the first moment, the expected returns, denoted by μi. We look at their second moment, so for each security, we'll have a standard deviation of return. And then for each pair of securities, we'll also have a correlation of returns. We look at the joint distribution of securities, focusing on the first two moments. And here you can see, if you remember a bit your statistics and probability, you can see right from the start that we're assuming we know these parameters, which in reality is never the case. You see, we're using the Greek letters, which is normally what you use in stat and probability to indicate the true parameter of the distribution, not the estimate. So that's one of the things that you find a lot in the literature on portfolio management. It's that a lot of the literature assume you already know the parameter for sure, which is never the case in practice. Now, of course, the further moments are important. Skewness, kurtosis are important. That's something that needs to be addressed with more sophisticated models. But it turns out that these assumptions, this set of assumptions is not as restrictive as it seems, because all of the elliptical distributions, so the family of elliptical distributions, is characterized by its first two moments. Among the elliptical distributions, of course, we've got the normal distribution, the nicest distribution of all, but the t distribution is also an elliptical distribution. So you can do the entire portfolio selection problem that we're going to do today and tomorrow in terms of t distribution. There is, however, one reason why we don't do it in class, but I can give you some references on that. The reason why we don't do it in class is that the t distribution is characterized entirely in terms of one parameter, which is the degree of freedom. So first you need to map the degrees of freedom into mean and variance. So the math is a bit cumbersome. But we know how to do it for a fairly large class of distributions. So this assumption is actually not as restrictive as it looks. It is restrictive, and we should do better. Okay, JP, for fixed income, the return would be the difference on the present value. Can it be approximated with the duration? We're going to talk about that in a minute. We're going to talk about what we mean by return in a minute, okay? So hold on to that thought. Here, we take the perspective of longer-term asset allocation. So you're not going to necessarily think about each bond at this stage. You're going to think about asset classes. That makes things a little bit simpler. If you look at bonds, then your best bet is actually to decompose the return on the bond in terms of where you see, so in terms of key rate durations, and model where you see the evolution of the yield curve. And then you do the same thing for the credit curve. So you end up with the multi-factor model. That's the cleanest way to do it bond by bond.